What's going on, everyone? Welcome back to the channel. Today is part 2 of our video on the US credit rating downgrade by Moody's. And today we're going to make a quick video talking about the top 4 implications of that downgrade. If you missed part 1, I posted it yesterday. We walked through the environment that led to this downgrade. So why did Moody's downgrade US debt, the US credit rating? Why did they downgrade the US credit rating? And today we're going to talk about what flows from there. So I included this slide in the last video as well. And I don't want to overreact to this downgrade, right? These aren't dramatic moves, right? It was a small downgrade. We went from the highest possible rating to the second highest possible rating. So it's not like, something broke here. But there are implications more so if this trend does continue. So what effectively happened? Well, Moody's said to investors, hey, investing in US credit is more risky now than it was X time ago. So what happens when something's more risky? Well, investors demand a higher return for investing in that thing. And that's the main thing for the top 3 implications you see here, is that investors are going to demand a higher return for lending the US money now that the US is considered riskier. And so that's where we start. Number 1, the first implication is higher borrowing costs for the US government. Whenever we have to issue new debt, if we are considered riskier, it's going to have to be at a higher interest rate. And unfortunately, we have to keep issuing more and more debt because we are running a growing US budget deficit. So I included a lot of these charts yesterday. Again, every president since Clinton basically shares blame in where we've gotten to. And as you can see on the right, yields are not following sort of their normal path. So the Fed has some control over the long end of the curve, so the 10-year. Not as much as it does the short term, but generally you see when the Fed's decreasing interest rates, the 10-year will also tick down alongside of it. But that has not happened since the end of last year when the Fed cut twice. The 10-year's risen. And so what that's meant is any debt the US has issued, since the end of last year has been at these higher interest rates, when they're issuing 10-year debt in this case. Obviously, the 30-year debt is going to be at the 30-year rate, which is a bit higher than this. 2-year debt's at the 2-year rate, which is a little bit lower than this. But as you can see, generally, regardless of where they're lending, it's going to be a bit higher than it was previously if those yields are higher. That leads us to number 2, related topic. We have to refinance our debt from time to time. We have a lot of it. We're trying to pay it off. We're meeting our payments. We have really high interest payments, as you can see here on the chart on the left. Recently, in recent years, I don't know exactly when that was, I think 2002, 2003, we actually spend more servicing our debt, so on our annual interest payments, than we do on our US military. That to me is crazy. So if you look here on the table on the right, you can see net interest at the bottom, the second to last row. It's actually, if you go to our discretionary programs, it beats both of those individually. And it's creeping up. We spend 1.5 trillion on Social Security every single year. Our net interest is at $1 trillion. And it's, as you can see on the chart on the left, it's rising fast. And so now, anytime we have to refinance debt, again, related to the last topic, we have to now do it at a higher interest rate, which means our interest expense is going to be higher. Now we're going to switch gears to the consumer. So number 3, higher borrowing costs sort of spread out across the economy. And consumers are also negatively impacted. So it's not just the US government, it's also going to be consumers that have higher borrowing costs. Because a lot of the yields that we interact with are based on another yield. So in particular, we're going to look at mortgage rates here. These 2 charts actually show the same 2 series. I just played with the axes so you could see sort of 2 different messages I'm trying to get out here. We're going to start in the chart on the left. As you can see, the 30-year fixed mortgage rate you can see the trends alongside that they generally move in the same direction, and the mortgage rate trades at a premium to the US 10-year yield. But that premium is relatively consistent. It does change, as you can see. It tightens up, it widens from time to time, depending on riskiness. But it's moving, those two lines are moving in the same direction. So when the US 10-year yield moves higher, generally the mortgage rate is going to move higher as well. And that's what you can see in the chart on the right. They are no longer on the same axes, as you can see. I shrunk the axes on the right, just so you can see that these two series do move together. So if the US 10-year yield is moving up, it's not just the government that's going to have higher borrowing costs. US consumers are going to have higher borrowing costs as well. And, we already have a housing issue, I would say, in this country. So if our borrowing costs go higher, I only think that stands to get worse. And then number 4, another one that this has a lot of implications. And just to plug something real quick, I did do a video on the US dollar's relationship to the economy. If I can figure out how to do the YouTube thing where the video pops up right now, I will. Still new to this. It's a really great video. It's been our most popular thus far. It just walks you through the relationship between the US dollar and the US economy. Very educational. I actually learned some things putting it together. So there's a lot of implications here of a weaker dollar, but in the heart of focusing on the consumer, that's what I'm going to talk about. So a weaker US dollar raises prices for consumers. So there would be weaker demand for the US dollar just simply because it's being signaled that the US is a riskier place to invest. So that would flow through to the currency as well. And this slide is from our last video, talking about the US dollar. A weaker USD coincides with higher import prices. I walked through the mechanics of that in the previous video, so I'm not going to do that here. However, the important thing to remember is when the US dollar is weaker, it costs us more to buy foreign goods. So we import a lot of goods right now, and this hurts the consumer if those prices go up. You can see from the chart on the left, as the US trade-weighted dollar falls, it is inverted here. So when it rises on the chart, we see an increase in import prices. That makes goods more expensive. And because our economy is almost 70% based on consumption, it's a huge number. Anytime we have a weaker USD, that normally constrains our growth. That's what I'm leaving you here today. This is the final part of the US credit downgrade series. Stay tuned. We'll have a lot more content soon. And if you enjoyed, I highly suggest that you subscribe to the channel. Enjoy your Memorial Day weekend. I will talk to everyone soon.